They didn't correct silver. They didn't cool it off. They tried to steal it from you. That is the only honest way to describe what happened over the last 24 hours. If you watched the market yesterday, you felt it in your chest. Silver was down nearly 8%. Red candles everywhere. Headlines screaming that the bull run was finished. And for a moment, doubt crept in. You thought about selling, not because the thesis broke, but because the pain was sharp and sudden. That reaction was the entire point. Now look at your screen today. Tuesday, December 30th. Silver is trading at $74.54, up $3.35 in a single session. Nearly half of yesterday's crash erased instantly. This wasn't a correction. This wasn't organic selling. This was a bear trap, executed with precision. A deliberate, algorithm-driven flush designed to do one thing before year-end: force weak hands out of their positions. The banks knew exactly where the stops were sitting. They knew retail leverage was piled up around $72, so they pushed price down just far enough to trigger panic selling. Stops fired. Margin calls hit. Shares were dumped into the void. And the moment that inventory was transferred, the engines reversed. In this urgent market breakdown, we're going to dissect exactly how this V-shaped recovery formed. Why the liquidity crisis we discussed yesterday was temporary, not structural. Why institutional window dressing has ignited frantic buying. And why the final 24 hours of 2025 may matter more than most people realize. Because here's the truth. If you're still holding, you are not the victim. You're the one who passed the test. To understand the violence of today's rebound, you have to understand the psychology of yesterday. When silver plunged towards $71, the market separated participants into two groups. The first group panicked. Over-leveraged traders. Tourists chasing momentum. People who believed in silver only as long as it went straight up. They sold the bottom. Not because fundamentals changed, but because volatility exposed them. And that selling provided something critical: liquidity. Institutions cannot buy unless someone is forced to sell. At $80, nobody was selling. Strong hands were locked in, so the market had to shake the treaty. Yesterday was the shake. Today is the harvest. Pension funds, large asset managers, commercial players covering exposure. They stepped in and absorbed what the panicked crowd dumped. Nothing fundamental broke. Samsung didn't stop making batteries. Solar demand didn't disappear. Mines didn't magically discover new supply. The dollar didn't become sound money overnight. The only thing that changed was sentiment. And once that fear was flushed out, price snapped back toward where the market is telling us silver actually belongs, well north of $74. Now let's talk about the real accelerant, the algo flip. Modern commodity markets are dominated by CTA's momentum-driven trading algorithms. Yesterday, when silver lost $75, those systems turned aggressively bearish. They dumped futures. Billions in paper selling hit a thin market. But today, as price reclaimed $73, then $74, the signal flipped. Those same algorithms were suddenly wrong. And when an algorithm is wrong, it doesn't hesitate. It reverses violently. They weren't just covering shorts. They were opening new longs at the same time. That's why you're seeing vertical green candles. The machines are chasing themselves, and price is the collateral damage. This is not speculation. This is market structure. And it's only the beginning. Now we need to look at the signal that matters most. Gold. Yesterday, gold looked terrifying. It dropped nearly $150 in a single session. Fear spiked. Cash was king. Bonds were breaking. But today, gold told the truth. The gold is trading around $4,373, up $46 on the day. It's stabilized. And that stabilization is the all-clear signal for silver. Yesterday, As drop in gold wasn't a repudiation of the bull market. It was a liquidity event. A short-term scramble for cash inside the bond market. That stress passed. And the market understands something most people don't. The Fed cannot allow a deflationary spiral. Quiet liquidity always follows visible stress. Whether through repos, balance sheet tweaks, or indirect support, the system gets stabilized. Once gold found its footing, silver was released. And because silver is high beta, it doesn't walk, it sprints. Gold up 1%, silver up nearly 5%. That ratio tells you everything you need to know. This is still a bull market. Silver always crashes harder on the way down and explodes faster on the way up. If you can survive the drawdowns, you get paid for the patience. Now, let's talk about the physical floor, because this is where the paper market lost control. Think about your bullion dealer. Yesterday, during the crash, did premiums fall? No, they rose. And today, with price ripping higher, are premiums collapsing? Still no. That tells you something critical. The physical market does not believe silver is cheap below $74. In fact, it's telling us that $72, $73 triggered aggressive real-world buying. During yesterday's sell-off, industrial buyers stepped in quietly but forcefully. They didn't wait for headlines. They didn't wait for confirmation. They bought at $73. They bought at $72. They absorbed the paper dumping like a concrete wall. This is why the crash stalled. The futures market tried to push lower, but physical buyers stood their ground and said, "We will take everything you have at this price." Eventually, the sellers ran out of paper. And when supply vanishes, price snaps back violently. That's exactly what happened. Now let's zoom out. We're trading at $74.54, right back inside the range. Monday's shooting star candle looked ugly, until today erased it with a green engulfing candle. In technical analysis, this matters. A breakdown that fails quickly is not bearish. It shows resilience. It shows trapped sellers. As we move into the final trading day of the year, Wednesday, December 31st, the stakes rise dramatically. This is where window dressing begins. Funds are judged on where prices close at year-end. Bonuses depend on it. Fees depend on it. Careers depend on it. They want silver above $75 when the clock stops. And they have exactly 24 hours to make it happen. This is why you're seeing aggressive buying. They are painting the yearly chart green before presenting it to clients. This isn't conspiracy. It's standard market behavior. And makeup costs money. They have to buy silver to raise the price. Right now, something rare is happening. Market structure and market fundamentals are aligned. Structure demands a high close. Fundamentals demand higher prices to unlock supply. When those forces point in the same direction, moves become explosive. If you held through yesterday, you passed the initiation. But don't get comfortable. We are still in ghost week. Order books are thin. Volatility can spike without warning. Another sharp swing tomorrow wouldn't change the thesis. It would confirm it. The primary trend has reasserted itself. The dip was bought. The breakdown failed. The bull is still in control. Now we need to talk about tomorrow, December 31st, and why it is the most manipulated trading day of the entire year. Tomorrow is Wednesday, December 31st, the final trading day of the year. On Wall Street, this is not a normal session. This is marking the close. Funds are judged on where prices finish at the bell. Bonuses depend on it. Fees depend on it. Careers depend on it. If they are long silver, they want it as high as possible. That's why today's $3 plus rally isn't random. It's the opening move of the year-end markup. Short sellers may try one last hit tomorrow, but the longs have deeper motivation. Bonus money. Never bet against a banker protecting his bonus. Now, let's address Monday's damage. Yes, silver briefly broke the 20-day moving average. but it reclaimed it within 24 hours. That's not a breakdown. It's a bear trap. The bears shorted the whole. Now price is back near $74.50. They're trapped. And trapped shorts become forced buyers. This sets up a classic slingshot pattern. Silver broke out, pulled back violently, snapped back with strength. The slingshot is loaded. Now the math. We consolidated between $65 and $75, a $10 range. Add that to the breakout point. That gives you $85. Silver rushed toward $83 too fast on Monday, driven by leverage. Now it's resetting for a healthier climb driven by institutional accumulation. January amplifies this. On January 1st, corporate budgets reset. Manufacturers restock. Fresh capital hits a market already short of supply. That's not Fed inflation. That's physical scarcity. Banks are still net short. They covered some exposure on the crash, but not all. As price pushes higher, pressure builds. At some point in 2026, a major bank will flip long. When that happens, suppression ends. Retail behavior confirms the trend. On Monday, fear. On Tuesday, dip buying. That's bull market psychology. Globally, silver is already breaking out in euros and yen. You cannot suppress a global asset. Now the warning. Volatility is not going away. As silver approaches triple digits, swings will become violent. Monday was a stress test. If you panicked, your position is too big. Your 2026 rule is simple. Focus on ounces, not dollars. Your stack didn't shrink on the crash. The currency just moved. Q1 roadmap. Retest $83, break to $85, open the path to $100 is not a prediction. It's a magnet. We are not in mania yet. We are still early. Final verdict. The crash was a gift. It flushed leverage, proved the physical floor, and strengthened the trend. The dollar is weakening. Debt is exploding. Silver is disappearing. You held the line. Now get ready for the repricing. 2026 is the payoff year.